Hello everyone, and welcome back to my next video on my series, in which I am covering the entire circular of RBI Draft Guidelines. And today we will cover the specific section number 13, and this section is basically related to exposures to subordinate debt, equity, and other capital instruments. Okay, so friends, before I begin, I request that if you have not seen my previous videos on this series, then you must see that, so it will give you a better clarity of what the circular exactly says. So this circular is a draft guidelines and is coming live on April 2027. Okay, so I'm just trying to decode this circular so that the people working in the credit risk landscape under the standardized approach, so you know that the parsing through the RBI draft guidelines can sometimes feel like deciphering a secret code. Okay, so therefore we are slicing and covering the each part of this circular in detail. And today we are straight away moving to section 13, as you can see on the screen, of the RBI's draft guidelines on the capital charge for credit risk. Okay, so we will be talking about the subordinated debt, equity, and other capital instruments. Right. So if you remain till end and if you watch the video completely, by the end of this video, you will have a crystal clear intuitive framework for how to classify these exposures and exactly what risk weights to apply to your banking book. Right. So we will be covering exposures to subordinated debt. Yeah. So friends, my objective is not just to help you memorize these numbers, the risk weights given here, but to understand the concept of in a very intuitive manner. Right. So before we memorize these things, let's understand that why, as you can see, the higher risk weights are applied here. So why higher risk weights are applied on these instruments? Okay, so the RBI treats investment lower down in the capital structure as the high risk assets, right? So to make sense of this, I can give you an example. You can relate it well. So think of a company as a ship. Okay, so there is a ship, and that ship is sinking in water. Okay, so if the ship hits an iceberg and starts sinking, so the capital structure dictates who gets the lifeboat first. Okay, so there may be many lifeboats. So who will get the lifeboat first? So the last one on the boat carry the most highest risk, right? And therefore the regulator requires your bank to hold more capital against those exposures. So these are all those exposures: subordinated debt, equity, and other capital. These are the last ones to get support, to get any benefit, to get any part of the liquidation proceeds, right? So these people are the last one to get the any benefit. So they are the most riskiest one. So therefore RBI has prescribed a much higher risk weights on this type of exposures, right? Now, to correctly classify this, the RBI guidelines looks past the legal name of the instrument and focuses entirely on something called, you will find here, it's something called economic substance. Okay, economic substance. So if it holds economic substance, then the RBI has defined the criteria to classify it, right? So we will move one by one on the three parts defined here. That is, one is subordinated debt, and other is equity, and then we will cover the other capital instruments, right? Now, first is subordinated debt. So what does this subordinated debt means? So if you go by the definition, these are the debt instruments issued by an entity that are subordinate to their claim to the senior debt, right? So if we take an example to understand this, so imagine a mid-sized manufacturing company, right? Say Steelworks Limited. I am just randomly taking a company name. It may or may not exist. I have no relevance to that company. Just for example. So imagine a mid-sized manufacturing company, Steelworks Limited, right? Now this company needs funding. Okay, so SW Limited needs funding. Now they can take a standard term loan from the bank. Okay, so but if they also issue a subordinated bonds to raise extra cash, right? Then what happens? if the steelworks in future goes bankrupt, your bank's standard term loan gets paid first, right? And the investor holding the subordinated bond have to wait in line, and they only get paid if there is money left over the senior debt is clear. Therefore, it is called subordinated debt, right? So, a SW Limited can either take term loan or it can issue subordinated debt, right? So, subordinated debt is what? If it's issue subordinated bonds, then in the case of liquidation, the investor holding the subordinated bond have to wait in line, and they only get paid if there is money left, right? After the senior debt. So these are the part of senior debt. Okay. Now you can see the risk weight. The risk weight is 150%. So because these bondholders are closer to taking a loss, the RBI assigns a 150% risk weight to these exposures. Right? It is clear. Okay. Then coming to the ultimate second risk bag, equity exposures. Okay. So you can see it is carrying 250% risk weight. Okay. So what does RBI says? RBI says an instrument is equity. First you have to classify whether the instrument is equity or not. So there are basically three conditions prescribed by RBI to treat an exposure as equity. First, second and third. What are these conditions? So RBI says that an instrument is equity if it takes three harsh realities for the investors. The first one is it is irredeemable. Okay. So you only get your money back by selling it if the issuer liquidates. Okay. Second is it carries no obligation on the part of the issuer to pay you. And the third one is it conveys a residual claim on the issuer assets or income. Right. So the first condition is it should be irredeemable. You cannot redeem it. Irredeemable. Second is no obligation. And the third one is residual claim. Okay. So what does irredeemable means? That you get only money back by selling it, or the issuer liquidates. You cannot redeem it, right? Second is no obligation, means on the part of the issuer there is no obligation to pay you. And the third one is the residual claim, means the issuer assets or income on the issuer assets and income you have your residual claim, right? Now understand it with an example. Okay, so let's say your bank buys a ordinary share, right? Your bank is here and it buys some share, okay, in a large publicly traded company, say any company. Okay, now this company is not going to refund you, right? So they have no legal obligation to pay you a fixed dividend. And if they go bust, you are the last person on the sinking ship. Understood? Now, because you are holding the ultimate risk, the RBI hits standard equity exposures with a 250% risk weight. Understood? So there are three conditions for considering an exposure as an equity exposure. Right. Now there are one more thing here, other capital instruments. What are these other capital instruments? So these are those instruments that don't fit perfectly into any of these three boxes, right? So any of these two boxes or three boxes you can say, if you consider equity, speculative, unlisted equity and subordinated debt, right? So other capital instruments, this is like catch-all bucket for capital instruments issued by the investing entity which are not included in the strict equity exposure definition, right? So think it of as a hybrid instrument, like certain types of preference share. Okay, so they act as a capital buffer for the issuer, but don't strictly meet all the three equity rules we have just discussed above. Okay, so these three rules, it doesn't strictly fit it, but it acts as a capital buffer. So ultimately they carry a still significant risk, so they also attract a risk weight of 150%. Right? Hope it is clear. Now the last one, the biggest one, is speculative unlisted equity. This is 400% risk weight here. Okay, so this is the highest risk category in all three. Okay, so speculative unlisted equity exposures, these are the equity investments in an unlisted company, means that are not listed. They are invested for short-term resale purpose, and they are basically venture capital investments, okay, which come under this category. These are subject to price volatility, bought in anticipation of significant future gains, capital gains, right? So for better understanding this category, you imagine a trendy unlisted tech startup called something like Next Gen Delivery. Okay, now your bank decides to buy 10% stake in this. Your bank decides to buy a 10% stake in this company. Okay, hoping the startup doubles in value in 6 months, so you can flip it for a massive profit, right? Now, because this is a highly speculative venture capital play, the RBI drops the hammer with a massive 400% risk weight, right? So this is highest risky segments. Now there is a crucial exception. I have to discuss here. Now there is a crucial exception here. What is that exception? Now suppose we have considered this company na SW Limited. Okay. Now what if SW Limited, from our first example which we have taken, could not pay its loans? Okay. SW Limited could not pay its loans for some reason. And your bank swapped, what your bank did, your bank swapped that bad debt for unlisted equity just to restructure the company, right? So what RBI says in this case? The RBI says debt equity swap for restructuring purposes or investments to establish long-term business relationship. Okay, or investments for long-term business relationship are not treated as speculative. These are not speculative, right? So friends, to quickly wrap up, to quickly summarize what I have discussed, I will just quickly summarize the key points. So when you look at an investment and you have to apply the risk weight, you figure out where it sits in the capital structure. So is it a subordinated debt or other capital instruments, it will attract a risk weight of 150%. And you have to see, is it a standard equity? Then you will apply 250% risk weight. And you have to check that are you playing the short-term venture capital game with unlisted shares? Then it will attract a 400% risk weight. Okay, so keep these definitions and number handy, and you will navigate this section 13 of the circular without breaking a sweat, I can say. Okay, and also keep in mind that this section excludes instruments your bank is already required to deduct from capital and equity investments in pooled funds. We will discuss it later now. Okay, so it excludes that. And if you found, friends, this breakdown helpful, hit that like button and subscribe for more Basel IV RBI risk management deep dives, and leave your question in the comments below. Until next time, keep your risk managed and your capital adequate. Okay, thank you, friends.